All right. Good morning, everybody. I'm here with my account executive, Brad, and we're launching a lot of new products. And these are really investor focused. So pretty exciting. We're just gonna next couple of days we're gonna cover one of those programs, and hopefully this information can help somebody, and it's found useful. So today we're going to be talking about our new program, one of our new programs, the fix and flip for 5 to 29 units. So, um, Brad, tell us a little bit about this program.
Thank you, Jacob, for having me on here. Hey, everybody, nice to virtually meet you. So our fix and flip program is it's not only just for 5 to 29 units; it's actually for 1 to 29 units. So if you have any single family residences that need some TLC or duplexes, triplexes, quadplexes, that also fits into this program as well. Condos, townhomes, even ALFs, that type of thing. So don't just think it's just for 5 to 29 units. Today we are going to focus on the 5 to 29 unit fix and flip, and that's a really big thing for investors right now because number one, there's just a lot of old apartment buildings out there
Mhm. Yeah.
that definitely need some rehab because you know we see it everywhere. There's housing shortages. We're
Mhm.
short close to 5 million houses out there, and a lot of people are staying away. Renters are staying away from those older apartment buildings, because they just
Mhm.
haven't been updated in quite some time. So if you're an investor and you're really looking to make some money off rehabbing a property and turning it into long-term rentals, or maybe even maybe a couple of units you could do short-term rentals in, this program would fit into that investment um, strategy for you.
So
So
Brad, real quick, so you mentioned something that was key there, and so the program is called fix and flip, but it's not really like you fix a property and then you immediately sell it, right? That's not
uh,
really like what we mean by flip in this sense, right?
right, yeah. So the strategy could be to fix and flip it, sell it, if you want to get out from under it, or you can uh, then flip the property to a long-term 30-year fixed product or program,
Okay.
or maybe even a 40-year, 10-year IO. It just kind of depends on what your strategy is and what market you're in. Um, so the program is also not just for U.S. citizens. You can be an I-10 borrower, or somebody
Nice.
without a U.S. social. Maybe they're here on asylum, political asylum, or something like that, and wanting to build up their war chest here. Or it could be just a foreign national. Maybe you live in
Okay.
France or Mexico or Canada or something
Mm.
like that, and you're wanting to invest in U.S. real estate. You don't have a social security card here or not a U.S. citizen. You can still participate in doing this fixing and flipping program.
Mhm.
Um, Really, you're just forming an LLC to start out with. Maybe it could be just a sole owner LLC, or maybe you're the money man and you have a general contractor that you found that can help you flip the property. You can form an LLC, put all those people on that LLC, and proceed with getting the loan through us. Now it
So
is a
so you wouldn't be able to buy the property in your own name. You have to have an entity.
it has to close in an LLC, correct?
Okay.
Yep.
Okay.
Now, going back to the initial question, it's not technically a fix and flip program. It's really a bridge product or a program.
Mhm.
So it is a short term, 12 to possibly 18-month term,
Mhm.
and it's interest only.
Mhm.
Um, and the rates, right now, the rates just in general have shot up in the past couple months. Everyone knows that. But the rates are pretty reasonable for this program. It's hovers anywhere from around the mid sevens to, I've seen, 12% for somebody who's not experienced at all, and this is their first flip. We try to hedge our bets a little bit by bumping up the rate a little bit. But for your well-seasoned investor or well-seasoned fix and flipper, the rate and the terms are going to be pretty attractive.
So, but so right now we're not talking about a long-term loan. We're just talking about the loan to rehab a property. So the
Correct.
12 to 18 months, and the interest rate, that's just for the rehabbing of the property.
Correct.
Okay. Okay. And then um, talk about like what cash the borrower would need to bring to the table just to get the rehab loan.
So for the acquisition of the property, if you are, like I said, semi well seasoned, the LTV or the down payment is going to be around 80 to 85 LTV or 20 to 15% down. Again, it depends on how much experience you have. This program is more of an experience driven program,
Mm,
not necessarily a credit based.
mhm,
So FICO does factor into it, but it's more experience. Now, we do allow you to, and this is what I was saying earlier, we allow you to partner up with somebody who's experienced. You know, if you're the money person, or maybe you have the good credit, we allow you to team up with the other person that might have the experience, or the other person that might have the money, to form that LLC, and then we give you the best case. So if you have somebody with a 800 FICO and the other two have 600 FICOs, we'll
mm,
give you credit for the 800 FICO. If you have a general contractor who's got 10 experience fixing and flipping, or maybe they
mhm.
own a couple just apartment buildings,
Yeah.
maybe they're a general contractor, maybe they're a realtor, we give you experience points, and then you're going to get better terms. So somebody who
Okay.
has 10 plus experience, they're going to get the 85 LTV on the acquisition. That makes
Oh,
sense.
okay. So now, what if someone has zero experience rehabbing multi-unit properties?
So, we'll still allow them to do that. We allow, uh, on the 5 to 29 unit, we allow a minimum of 30. So let's talk about the experience. You can be a general contractor, you can be a realtor, and you can own an investment property. It doesn't have to be a fix and a flip.
Mm,
Um, or you own a commercial building, maybe you own a warehouse or a gas station or something, office building.
mhm.
We'll give you 3 experience for that.
Okay.
So you don't necessarily have to do a fix and flip, but we still allow you to get some experience points. Now, on the 1 to 4 unit, you can literally have zero experience at all, and we will allow
Okay.
you to do the fix and flip. On the 5 to 29 unit, we figure that's a little bit of a bigger project,
Mhm.
so we try to hedge our bets a little bit by requiring you to have a minimum of 3.
Okay. So if you have zero experience with rehabbing and multi-unit properties, then you probably want to start with a 1 to 4 unit, or partner with someone that's experienced. You know, both of you are going to be partners or members of the entity, whether it's an LLC or S corp or
Correct.
okay.
Yeah, and
Uh,
then you can kind of figure out the percentage of ownership. So maybe if your contractor um, essentially is in the deal just to do the fixing up of the property and give you the experience,
mhm,
and you're the money person, maybe you might own 70% of the LLC, and then the contractor owns 30, and then that's essentially how you pay the contractor. Is if it's an exit strategy and you're just going to sell it, then they get 30% of the proceeds,
mhm.
right? Once it's
Right.
once it's fixed up and the after repair value gets figured out.
Okay.
So it's all on a case by case basis for how we give experience out, and what experience points we will give you essentially. So we trust the person filling out the application up front so we can get them pre-approved, but
Mhm.
then on the backside we'll verify the experience.
So
So
let's go back to the credit. So you mentioned the credit a little bit, but can they have a credit score as low as like 575? I thought that was possible, but I want to make sure.
So on the fix and flip, we do cap it at 600. We want you to have a
Okay,
minimum of
600.
600. But
Okay.
like I said, on the flip side, we give you the best case. So if maybe you have all the experience and you have the money, but you have a crappy credit score, put your mom on the put your mom on the loan with the good FICO, and we'll give you the best case.
Okay,
So
so because there's two parts of this transaction. There's the fixing part of the property, but then and that's a short-term loan to get it fixed. But then once the property's fixed, you have to look at a long-term solution, whether if you're going to sell it within the term of the initial rehab loan, and then at you can sell it or you can transition to
a
essentially
long-term DSCR 30-year fixed
right.
long-term product or program, whatever you want to call it.
So essentially, you would refinance the rehab loan into a different loan, pay off that
Yeah,
loan.
exactly. Yeah,
Okay.
and a lot of lenders, if you come to a lender, a lot of times they will say, hey, this property needs to be seasoned for a minimum of 6 months before we will allow you to refi it, whether that be a cash out or a rate and term into a long term DSCR loan. We don't have that seasoning requirement because we figure if somebody's fixing and flipping it, they're going to have the receipts. So if
Okay.
we can verify and see, what work has been done, then we will typically give you the new after repair value or the new appraised value of the property. So
Okay. And then when we're talking about DSCR, we're just talking about what income is going to be used to qualify for the payment of the long-term loan. So debt DSCR being debt service coverage ratio, or basically does the rent or the rents for the multi-unit property cover at least 100% or more of the new mortgage?
So yeah, whenever you do a fix and a flip, or I'm sorry, a fix and a hold strategy, we want you to have a minimum occupancy physical of 85%.
Hmm.
So as long as you have lease agreements for 85% of the units,
Okay.
we're going to look at those leases. We're going to want to see the first months of payment deposited into the account, and then we can typically go off of the lease for qualifying the cash flow of the property. Um, we will also verify that by looking at a schedule of market rents whenever the appraisal is done. So
Hmm.
the appraiser is going to go out and look at the market rents and determine a rent roll number that gets attached to the appraisal. So what you want to do, actually, the strategy is give the lease agreements to the appraiser and say, hey, here's all the lease agreements. Please take this into consideration whenever you're giving us a rental estimate. And usually those two will match up and you won't have any problems. Um, you run into problems whenever the DSCR ratio is negative on multifamily. So the DSCR is the proposed payment, interest, taxes, insurance, HOA dues divided by the rental estimate.
Hmm.
So, and if that payment is higher than what the rental estimate is or the lease agreements are, then you're negative on the cash flow because you're paying more for the mortgage than
Yeah.
you are collecting in rents, and that's a problem in multifamily. Usually, you want to have a positive cash flow of at least 1.25 on the DSCR ratio to get the best terms whenever you're refining it. Typically,
Okay. And then can it work as long as it's if it breaks even at 100%, or does it have to
it
be like over?
it can, yeah, it can. It's just you're going to have a little bit of a rate hit, and you're going to
Hmm.
also get a little bit less on the LTV. So your cash out might not be as much unless you have, like I said, that positive 1.25 DSCR typically.
Okay.
Um, so let me go ahead. I'm going to share my screen real quick. That way people can kind of get an idea of what like the LTVs are and the rate looks like and the experience. Um, so I'll do this just real quick here. And it looks like I'm sharing my screen. So if you can allow that to be, there we go. So here's what I was talking about earlier with the experience. So your experience, here's the rate ranges, here's the LTV, and we're really looking at the purchase and rehab. That's the fix and the flip there. So here's your LTV on the acquisition or the purchase. Here is your after repair value. So these two numbers typically are the most important. This loan to cost, it's not really that important, especially until after we get the reconciled appraised value in there. And really, this loan to cost is more of like a new construction um, focused number. But typically, if the LTV, or I'm sorry, if the ARV works, this loan to cost will work anyway. So we calculate the LTC. You don't really have to worry about that. So the two numbers that the investor has to focus on is the LTV. Can they swing a 15% or a 20% down payment on that property, or possibly even a 25% if they have little experience? And will this after repair value figure work for their project? So the after repair value is determined typically by the investor or the sponsor, they call it. And that's, you just run the comps up front. Hey, if I purchase this property, I put 20% down and my budget is, another 20,000 or so. Will that factor into the after repair value and us taking 75% of that after repair value? So let me give you an example. I buy a multifamily property for $500,000. I got to put 20% down because I only have 49 experience. So I got to come out of pocket, 100 grand essentially. So I'm going to have a loan amount of $400,000. Um, my budget for the repair, I'm going to say, let's just say $100,000. So my total purchase loan amount plus my rehab that is being requested is a total of $500,000. Say this property um, after repair is worth $900,000. So I'm going to take $900,000 times 0.75 times 0.75, and that's going to equal $675,000. So on this particular project, $675,000, which is 75% of the $900,000, is my total allowable or max allowable loan amount. So I can see that my $500,000 loan amount is way less than 675. My numbers work. Does that make sense?
Yep. Yep. Cool.
So I definitely want to like jump into this a little bit heavier,
Oh,
maybe on the next one. Especially hitting the 1 to 4. But I just really wanted to go over a high level on this fix and flip program. It can make you a lot of money, especially if you're fairly experienced, or maybe people that you can team up with and attack these properties. There's a lot out there. Um, and there's a lot of people needing housing. So I would say if you're going to do a fix and a flip or fix and a hold strategy, either one in this market should work out pretty well for you, especially if you're in Florida or in Texas or Arizona. Those spots are pretty hot right now. Even California,
hmm.
there's a lot of those properties in California that need this fixing and flipping. And a lot of the heavier commercial lenders out there, they make you have like minimum loan amounts of 500,000 or 5 million, or maybe even 10 million, or they won't talk to you. We allow a minimum loan amount of 300,000 on multifamily. So as long as it fits within those parameters, you can pick up some distressed properties for a pretty decent price, and really make some money.
Nice. So just to recap, so credit. we're looking at a minimum of 600.
Correct.
Okay. The income's gonna
Experience.
the experience. So there's options if you have zero experience for the 1 to 4 units. Down payment, we're looking at anywhere from, let's say, zero experience to the most experience. What is it? 25% down payment, or what's the
It's yeah, the highest is 25%,
right?
or 75
25%.
LTV,
Okay.
and this is 5 to 29 units.
Okay.
But the least amount down is 15% or
Okay.
85 LTV
Okay. So
on
anywhere
the
from
acquisition.
25 to 15% down, depending on experience and the type of property, over over 4 units or 1 to 4
And
units.
FICO could play a little bit into that too. You
Mhm.
know, if you have like a really bad FICO, usually we'll knock it down a little bit. So
Okay. And then lastly, as far as like income, that's going to be based on what the property rents for.
correct, yeah. So we're not going to look at the actual borrower's income. We don't care about their current income, their job experience. We don't look at tax returns or any of that stuff.
Nice.
Um, but yeah, we're more focused on the cash flow of the property once you flip it into a long term deal.
Okay. Cool. All right. I think this is good. It's a pretty cool program. So, Brad, appreciate you sharing a little bit about that, and hopefully, somebody takes advantage of this because like you said, there's a lot of areas I've seen. Um, some areas in the Houston area, like Galveston, for example, that area is kind of blowing up, and
Yeah,
properties are still reasonably priced. They're not crazy out there. So I think this is a really good program.
yeah.
Uh,
I know there's a lot in Galveston. I did a little bit of market research. There's a lot in Pearland. I've seen a lot in like the Woodlands area. So even those richer areas of Houston, don't shy away from those places. They might be priced a little bit higher on the acquisition, but the after repair value might be even greater. So your internal rate of return is probably going to be a tad bit higher, and it'll probably sell a lot quicker too. So if your strategy is to exit the loan, so
Nice. Cool. Okay, well, I appreciate you sharing a little bit about that program, Brad. And then tomorrow we'll talk a little bit more about the 1 to 4 units, specifically. And then,
reach reach
yep,
out to Jacob with your investment deals, guys.
yep, absolutely. Reach out to me through Facebook Messenger. Yeah. All right, Brad. Well, thanks a lot, man. I
Uh,
appreciate you taking a little bit of time out to share this new program. And yeah, we'll connect again tomorrow.
Sounds good, Jacob. Thank you.
All right. Thanks,
Bye,
Brad.
everybody.